An important part of a country's economic management, but a lesser understood one, is monetary policy. It's a policy that looks no further than to manage a country's money supply, but its mechanisms are a bit complex. So before we launch into anything else, we need to look at why the money supply is so important. And to do so, we'll draw up an example. Let's say you have Kevin and Lisa here, both who have $10 which they each spend on groceries each week. They both buy 5 apples each week from their local greengrocer. Now let's say that Kevin and Lisa suddenly have more money because they got a raise, and they can now afford to spend $20 a week on groceries. They both now instead want 10 apples each week. All of a sudden, the greengrocer is being faced with more demand, but only has a limited supply of 16 apples each week. Because supply is limited and demand has increased, the greengrocer now is in a position to raise prices for apples until Kevin and Lisa only want 8 apples each week. The phenomenon which we've looked at here is inflation, where this small economy's money supply has increased because Kevin and Lisa have more money, resulting in an increase in prices because resources in an economy are ultimately scarce. Economists often use the CPI, or Consumer Price Index, as a measure of inflation, which takes a basket of goods and services like food, housing, entertainment and apparel, and it calculates the average change in prices of the overall basket. Economists have found through decades of research that small amounts of inflation, such as 2 to 3% each year, is a good thing because it means the economy can grow in a way that is sustainable. History has shown that if inflation is too high or if deflation occurs, where prices in an economy decline, this can destabilize an economy and cause much larger fluctuations in the economic cycle. So monetary policy is an important tool to manage inflation and ensure that an economy can achieve stable growth over long-term periods. The institution in charge of monetary policy is the Reserve Bank of Australia, which is Australia's central bank. And I'll explain what they do. A central bank is different to a traditional bank because it functions as the bank of banks. So traditional banks by law have to keep a certain percentage of deposits in the country's central bank. This provides insurance in the instance that a traditional bank collapses and helps to reduce the threat that this could have on the entire economy. So the way it works is that the central bank will lend deposits back to the traditional banks at a specific rate called the overnight cash rate. If the overnight cash rate is low, banks will find it easier to borrow from their deposits, giving them more ability to lend out to people and businesses and help expand the economy's total money supply. If the overnight cash rate is high, the banks will be discouraged to borrow from their deposits. This means the banks will have less money to lend out to people and businesses and help contract the money supply. So a tool that the RBA uses in monetary policy is setting the overnight cash rate for traditional banks. Traditional banks will then use the overnight cash rate as a guideline to set the interest rate on deposits in their own bank and the lending rate. If you've understood everything so far, you'll now see that when the economy is going through a downturn, the RBA will usually step in by lowering the overnight cash rate, so that traditional banks make credit more available. The more that credit is available, the more that people and businesses can continue borrowing and spending, with the hope that this reverses the downturn. The RBA will do the opposite and raise rates if it senses that the money supply has been growing too quickly and if inflation is getting too high. So this is the basics of monetary policy. It's a tool used by a country's central bank to influence the supply of money in the economy and work towards creating stable long-term economic growth.